Welcome to Daybreak Australia. I'm Paul Allen in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens. The top stories this hour. A mixed open ahead in Asia after Wall Street closed off session highs. Chinese market set for a further boost after the PBOC's surprise announcement of a reserve ratio cut. Tesla shares slipping in late trade as it warns of notably lower sales growth this year as fourth quarter earnings miss expectations. And AI chip demand set to propel SK Hynix to its strongest quarterly sales growth in almost 2 years, with results due in the next few minutes.
All right, let's get straight to some breaking news out of South Korea. It is GDP numbers for the fourth quarter and coming in line on quarter, 0.6% growth on year, 2.2% growth. That was a narrow beat, but South Korea's GDP for the entirety of 2023 was 1.4%. So that's very much in line with expectations as well. South Korea, of course, a very important bellwether for the health of the world economy. And it was last month that the US overtook China as South Korea's most important export destination as well. So the GDP numbers coming in very much in line with expectations. South Korea, of course, having a parliamentary election in April as well. Okay, we had the won last trade at 1337, so we'll be keeping an eye on the currency a little bit later on as that begins trading. But let's take a look at what to expect for markets around the region. Not a huge amount of change for the Aussie 10-year. Yields creeping up just a little bit, 4.276. Yields creeping up across the curve. In fact, the Aussie dollar has been pretty stable the past few days at that 65 cents level, just below 68 cents US. And we've just opened for trade here in Sydney as well. The ASX right now just in the green by a few points, but as we know, staggered open here, so we'll get a better gauge of what's going on in a few minutes' time. New Zealand, meanwhile, been trading for a little while. That's up about 0.1%. Nikkei futures slightly in negative territory. The yen strengthening just a little as well, 147.50 against the dollar at the moment. Chinese stocks had a very good day on Wednesday, so we'll be watching again today. Of course, Bell, the market really liking this narrative coming out of policymakers, but the key question is, can this rally be sustained?
Yeah, that's right. We haven't really seen policy measures like this leading to substantial gains in the past. But we've got a couple of movers as well to check in on because of big Wall Street earnings after hours today. So Tesla, you can see here, dropping nearly 5% at this point. They've warned car sales are going to be lower over the course of this year. We don't know exactly how much lower, but Tesla is saying it could be pretty notable. So fourth quarter profit and sales also missing expectations from Wall Street. IBM, it's quite a different story for this company. You can see there the shares that are moving higher here. Good outlook for revenue, cash flow into 2024. Some job cuts, but just only a few from the company as well. And they're seeing strong AI demand, and that's growing by the day. So let's take a look at how that's sort of feeding into the futures landscape. We just had those coming online for US stocks, and you can see here some pretty flat moves overall, but we did see stocks still continuing to trade around record highs for the S&P 500, tech stocks as well. Chinese shares, you mentioned those moves that we saw in the CSI 300 Hang Seng yesterday, and we did actually see that translating across to the Wall Street session because the Golden Dragon Index there up 1.8%, Paul.
All right, just want to get you across some more breaking news on the Bloomberg at the moment. A Bloomberg scoop here. We're hearing that David Allison has made a preliminary offer to buy National Amusements Incorporated. This is the holding company of the Redstone family, and this would be a way to take control of Paramount Global. Of course, that's a media giant that owns MTV and Nickelodeon as well. Now, this is according to people familiar with the matter. Were this to go ahead, it could have quite a complex structure. Paramount's share price, of course, has been slipping a little. The stock market value currently about $9 billion. So we do have word, though, that the Allisons might have secured the blessing of Warren Buffett. This, again, according to people familiar with the matter. That's a story to watch. Bell, David Allison there, apparently making a preliminary offer to buy National Amusements Incorporated as a way to get control of Paramount Global.
Yeah, certainly something to be tracking. But the top story this hour and over the course of yesterday, as well as China cutting the reserve requirement ratio for banks by 0.5 percentage point in early February. The PBOC governor made the announcement in a press conference on Wednesday, and it's really been a very rare foreshadowing of policy change.
There is still sufficient room for China's monetary policy in the next stage, and we will continue to strike a balance between short-term and long-term, between stable growth and risk prevention. Starting from February the 5th, we will lower the RRR by 0.5 percentage points so as to inject 1 trillion RMB liquidity into the market.
Our global economics correspondent Enda Curran joins us now. Enda, I think perhaps just start off with the significance of this sort of cut, because saying it or signalling it this much in advance maybe tells us that there's just no other effective tools that are available.
Well, it certainly does indicate a new sense of urgency among the policymakers in Beijing. You made the point of making that move on the triple R. They announced it in advance. That in itself is unusual. It's a larger cut than they normally would make. They're going by 50 basis points. There were some other measures that the authorities are talking about as well. For example, making it easier for property developers to get access to their financing, talking up financial links with Hong Kong. So there's some, trying to change the mood music, and clearly it's having some impact. But to your point, though, I think that the entire world has been looking at China and wondering when and how they might pull a circuit breaker for the economy, for the slowdown, for the property market, and when they might start to turn things around. I don't think anyone's especially convinced that this kind of move will do that. I think most people would say to you short-term interest rates aren't really the problem with China's economy. Global sentiment is negative, foreign investment's weak, global capital is leaving China at a fairly decent clip. And I think this move by the PBOC may calm things a little bit on this side of the Chinese New Year holiday. It may help sentiment around the margins, but I don't think it's going to do much for the structural problems. And that's the way I think a lot of analysts are eyeing the news out of Beijing overnight.
Yeah, and it keeps cycling back to this problem. Is this the right medicine for what's going on, for what appears to be a crisis of confidence? What would the right medicine be?
Well, I think the PBOC governor made some points as well. He spoke about that they still have fiscal room, for example. I think a lot of observers looking at the China story would zero this in on, number one, the property sector, on the real estate slowdown. That's really what's dragging on everything else, dragging on the consumer story, dragging on sentiment. So they've got to go in there and go hard in terms of trying to fix that. And of course, one way of doing that is on the fiscal side, with the central government intervening to borrow and spend more to support projects and to get activity up and running and get animal spirits motoring around the economy. So I think the global audience are looking for solutions from the fiscal side, but the authorities are clearly being very conservative in their approach. They're not yet willing to go down that road. Obviously, we know they've been burned by the debt build-up in the years after the financial crisis and everything else. They haven't really fully given up that narrative just yet. So I think, for the rest of the world looking at China saying, when's it going to turn around? When will it unleash the kind of stimulus needed to do so? I don't think the measures so far will convince that audience that they will. And I think a lot of focus will be on now what kind of fiscal steps they do take over the weeks and months ahead.
That was our global economics correspondent, Enda Curran there. Let's get to some breaking news now on Boeing, because we've got some lines that are just dropping from the FAA here. This is relating to Boeing's MAX production. We understand that has been halted by the FAA, and that includes for the 737-9 MAX aircraft that, of course, did have that recent Air Alaska incident. The reason for that halt, well, the FAA says that it needs to increase oversight of Boeing's production lines. It's saying that the quality assurance issues that they've seen so far are unacceptable. We do have a statement just coming out from the company, and this is where it's coming from, saying FAA telling Boeing that it won't grant any production expansion of the MAX, including the 737-9 MAX, the regulator saying that in a statement. So really one to be watching, because Boeing has been making a lot of efforts to try and emphasize that focus on safety, that focus on quality, but still, Paul, clearly a long way for that company to go in that quest. And the stock there you can see slipping in after hours.
Yeah, let's get back to the story out of China about the looming RRR cut and whether or not these policies are going to make any difference. We're joined now by Kerry Craig, Global Market Strategist at JP Morgan Asset Management, joining us today from our Melbourne studio. So, Kerry, a 50 basis point RRR cut foreshadowed. Is this the right medicine? Does this fill you with confidence? Want to pile back into China now?
No. Good morning, Paul. Well, I think the urgency around the move, the fact that we saw that larger move come in earlier than expected, does suggest there's still policy support for the economy and for the market. I think our view is that we've seen incremental policy changes come through over 2023. We had expected those to improve the growth outlook for China this year as they generally feed through into the economy, and this will give a little bit more boost, but it's probably not the right thing to really shore up confidence around the property sector as much. There's still a huge focus on the production side of the economy rather than thinking about the consumer and consumption. I think that's where the real focus lies, to try and reignite that consumption growth in the economy and see those better growth rates really feed through and lift private investment.
So in terms of that, what sort of announcement would you be looking for to give you more confidence in China markets?
We want to see more action around actually supporting the property sector in general, thinking about that balance between lifting home prices that obviously feed into the wealth narrative for many homeowners, and also trying to balance that out with making them sort of relatively affordable. We want to see them remove a lot of the risk around further failure of completions of those existing projects that come through, and also thinking about the fact that we want to actually see that consumption reignited to release all those built-up savings that consumers in China still have that haven't had the need to release them. So I think more focus around the consumption, really linking to that wealth effect around the property sector, would be something that we would be looking for in terms of that more sustainable growth outlook. For now, it seems there is more scope on the fiscal side, but a lot of it's going towards addressing some of those issues around local government financing and thinking about that infrastructure investment a little bit more rather than thinking about the consumer.
And what are the sorts of fiscal policies that you want to see in particular to try and lift consumption?
Well, we already actually have seen quite a big move on the fiscal policy. We sort of feel an out-of-cycle movement in terms of raising that debt-to-GDP ratio last year. I guess the market's just been a bit underwhelmed that we haven't seen a huge number being announced by China. It's been more these incremental policy measures, and they will add up, eventually leading to that growth. I mean, they did announce a growth figure that was probably a little bit higher than many expected for the full year when they came out with their GDP figures, but we want to see more around, I guess, a larger number being announced to really address the market concerns that China has the capacity and willingness to really shore up the economy, whereas I think that's what's been lacking right now, and again, evidence from the flows out of investments in China over the last few months.
So China not perhaps the preferred market really for any investors in the moment, but where are you looking to in particular, or is it any specific sector instead?
I think for us, China is, still worth watching, given the valuations have come down so far, and there could be a nearer-term rally if we do see further policy announcements coming through. We still think about the longer-term potential for the Chinese growth. More broadly, when we think about asset allocation this year, though, we are seeing, an environment we have moderate growth when it comes to the US. We're thinking about falling inflation. We're thinking about rate cuts from central banks around the world. That does provide quite a positive outlook for both stocks and bonds. On the equity side, though, on the stock side, it is about being more measured in those return assumptions. So we would still favour a quality bias, given some of that uncertainty that does point us towards US large cap. We like what's happening in Japan, so we would think about the valuation argument there and the movements potentially by the Bank of Japan helping some of the financial sector, but also looking towards perhaps what could be a later rally out of Europe if we do see stabilisation in the economy that's kind of lacking at the moment, and thinking about that relative valuation argument there. More broadly, though, I think the credit market and the fixed income market is most interesting, given we have seen quite a large movement of bond yields down and seeing that come back up, and thinking about the yields that are offered within high yield at the moment in terms of that carry potential.
Kerry, you mentioned US large cap there. We do have a chart on the Bloomberg terminal which illustrates just how far stock prices have gone up. Meanwhile, earnings are coming down. So just quickly, do you feel like there's some pressure on some of these big companies to justify some of these lofty valuations when it comes to delivering earnings?
I mean, there has been a bit of a disconnect between market cap and earnings when we look at some of these top 10 stocks, but I think there could be a bit of a rebalancing across the US market as we see a bit more rotation into other names within the S&P 500 and potentially into some of the smaller cap names as well. Very cautiously there, but I think some of the rotation you may see in the market is really what will keep it going this year away from those leaders that we saw in 2023.
That was Kerry Craig, Global Market Strategist at JP Morgan Asset Management. Thanks very much for your time this morning. Well, coming up, Tesla sees a slower growth rate for 2024 as its fourth quarter profit misses estimates, and we are seeing that stock there falling nearly 5% in after-hours trade. More ahead. This is Bloomberg. All right, we're on the countdown to SK Hynix, set to report its latest earnings at any minute now. So it is expected to post its strongest quarterly revenue growth since 2022 as the global chip demand returns. Let's get more now with our Asia Technology senior reporter, Yulim Lee. She's in Seoul and joining us from there. So Yulim, what exactly are you expecting? The numbers actually,
yes,
Yulim,
right.
sorry, I'll just jump in here and say they have just come out at this very moment here in time. So we've actually seen that net loss coming in at 1.36 trillion won. The estimate was for a loss of 407.5. Operating profit, meanwhile, rising to 346 billion won. The estimate had been for a loss of nearly 170 billion won. Instead, sales coming in at 11.3 trillion won. The estimate had been for 10.4. So Yulim, just with that in mind here, it does seem at the headline that the numbers are better than what was expected.
Yeah, that's right. Thanks for telling me the numbers right now. I've been eagerly waiting for them. Basically, what this is showing us is that it's a surprise, earnings surprise. Basically, they were expecting to post operating loss of about 170 billion won. For the December quarter, and that was going to be the 5th consecutive quarterly losses for the company. What the numbers are telling us is that they actually posted a profit, operating profit for the quarter, which is a surprise. And I think it really indicates that the recovery in the memory chip market that has been in the prolonged slump is really starting to take place. So obviously the SK Hynix has been benefiting from a boom in demand for high-end memory chips that power AI applications, and it is a leader in HBM, which is high bandwidth memory chips. And its lead over Samsung has helped the company to really boost its shares. And in December, it became the second most valuable stock in Korea after Samsung. So it remains to be seen whether we will find out more details during a conference call soon. But it's really coming at a background of some positive numbers. TSMC has just reported last week, giving a very positive outlook for 2024, and ASML, which is a major bellwether for the for the semiconductor industry, just reported bullish orders for the quarter, which really sent their shares to a record high. So it could potentially move the stock today.
Yeah, potentially. That's a staggering difference between expectation and reality there. In terms of the potential stock movement today, we're already up 60% on year. What sort of movement can we expect to see at the open?
Well, I think, given the ASML's performance overnight, it really surged to a record high. And that's a really big move in the semiconductor industry. So I think, the setting is really positive, and they just reported, earnings that really beat expectations in a big way. So it could potentially move the Korean stock market too.
All right, Asia Technology senior reporter Yulim Lee in Seoul on those SK Hynix numbers. All right, still to come, we will discuss Boeing a little bit more, the breaking news out of there. We'll have a look at what to expect in terms of markets as well on Daybreak Australia. This is Bloomberg.
The top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Let's take a look at how Boeing is doing. We've got shares falling 3% after this news that the FAA has halted MAX production. So a big story coming out of Boeing today. We're seeing shares falling after hours. This includes the 737-9. So Boeing MAX production expansion halted by the FAA. So we're seeing a big movement there in shares. Also keeping an eye on Tesla, of course, shares falling in extended trading. Fourth quarter earnings coming in short of expectations, and it issued a warning of weaker sales growth ahead as well. Detroit Bureau Chief David Welch joins us now for more. So David, why is Tesla's growth rate slowing?
EV demand has softened a bit. There's still growth there. It's, there's been a narrative out there that nobody wants EVs anymore. It's not really true, but there is a lot more competition. So you look at the markets where Tesla sells a lot of vehicles. China, BYD now surpassed China as the #1 seller of EVs. So while Tesla is growing in the market, others are taking some of that growth. So they're not growing as fast, and even though they've lowered prices, so their revenue isn't as strong. In the U.S., EV demand itself is slowing because there aren't enough cheap vehicles and there aren't enough charging stations. And then in Europe, good growth there for everybody, but again, when you don't have enough inexpensive EVs out there, you start to get past the early adopters, past the luxury market, and it's tougher to find buyers. So you boil all that together, Tesla's automotive revenue only grew 1% in the fourth quarter, and it looks like their vehicle sales are going to grow about 20% a year, and it wasn't that long ago, they talked about 50% a year. So investors are looking at this as a company that's growing, but it's not a hot growth story anymore, and that's why they always invested in Tesla.
Tesla didn't give a forecast for sales this year, which is pretty atypical for the company. So what's the exact significance of that, do you think?
That tells investors that the company doesn't really know how fast they're going to grow anymore. They were adamant for the longest time that it was 50% a year. And then a couple quarters ago, Elon Musk said that they couldn't grow at 50% forever. It just wasn't possible. But now they're looking at 20%. And if they grew 20% last year in vehicle sales and they aren't going to give us a number this year, then that tells it it could be even lower than 20%. And so, it'll still be a growing company probably, but if you're not growing even at 20%, it's really a come down from where it was, and investors just want a better handle on things, I think, and that's why you're seeing some people leave the stock.
Yeah, we've seen Tesla and other EV makers aggressively reducing prices. How has this price war been affecting earnings?
Well, look, they missed on earnings per share just by a small amount. They did slightly beat on gross margins, which is a very watched metric for Tesla. It was 17.2% instead of 17.1 was what the street had for them. But they used to be over 20%. So when you start cutting prices, it brings your margin down, it brings revenue down. And, 17, 16%, that's kind of where General Motors is these days. So the profitability's come down as they cut prices. And they're not getting the kind of growth they used to, even as they've slashed prices by 25 or 30%. So they're starting to look more and more like an ordinary car company, even though they make all electric vehicles.
David, thanks so much for your time. That was our Detroit Bureau Chief, David Welch there. Up next, we'll get more reaction to those bumper numbers from SK Hynix. Daiwa Securities is joining us in just a few minutes. This is Bloomberg. You're watching Daybreak Australia. We're just drawing attention to one of the breaking news this hour, SK Hynix. So this is the world's #2 maker of memory chips, reporting a surprise operating profit for the fourth quarter. So what really drove that was strong sales of high-end memory chips. It's a big supply into NVIDIA. Those chips are used to help train AI tools. So has been a big beneficiary of the demand for that product. So recapping that number here, profit of 346 billion won. That's just under $260 million. And that compares with an average analyst estimate for around 170 billion won loss. So moving instead to a surprise profit here. Let's get more on that now with SK Kim, Executive Director and Analyst at Daiwa Securities. These are really incredible numbers, perhaps coming through from SK Hynix. What's your reaction so far?
Hello. So SK Hynix just announced first quarter earnings result. Actually, its earnings is much higher than the market Bloomberg consensus. Yeah, we think that it's mainly coming from the, high price hike, the memory price hike. The memory price rebounded from first quarter last year, but we still believe that SK Hynix, they have even recorded higher ASP. Because of their, higher exposure with the premium products such as HBM3 and DDR5.
We can get more on HBM in a moment, but do you think, where does that tell you that we're at in terms of the recovery of the chip sector generally?
Yeah, actually, memory cycle is turned around. That is driven by actually supply. Cut. So memory suppliers expanding production cut in second half last year, and because of that, some OEM such as PC and mobile, they worried about the supply shortage in 2024 this year. So that we saw some restocking demand from the mobile and PC OEM. But I think that the supply cut, the production cut is the main driver for the recovery in the cycle.
So, like you said, a lot of this is coming from that demand for HBM chips, high bandwidth memory chips that are used for AI. Do you think that Hynix can continue to maintain its competitiveness in this field and really continue, given you've got the likes of Micron and Samsung as well that are ramping up production?
We anticipate Samsung Electronics will start supplying HBM3 to NVIDIA from first quarter, but the supply has been delayed. We assume some qualification related issue. So I think they just started supply of HBM3 to NVIDIA. But still, majority of the HBM3 product is supplied by SK Hynix. So Samsung supplied more as of now to other customers such as AMD and hyperscaler. But as you know, that NVIDIA is still they're maintaining dominant position in the AI GPU market. So Hynix will continue to benefit from this the market, the landscape at least the first half this year until.
The chips business is, of course, a very cyclical one, but with the amount of demand for memory chips and other chips coming from the AI revolution, can you see longer term that chip cycle might be starting to get a bit longer? Is there just enough demand now to go around? And how does that dovetail with SK Hynix's CapEx plans for this year?
Yeah, I think the recovery in demand is not that meaningful yet. Because of the general server demand remain weak. So we anticipated this demand will recover from second half this year. But as you mentioned, the AI-driven momentum is still very robust. Demand momentum is very robust. And also we expected some meaningful rebound in demand. Especially the AI-driven the cloud, the CapEx cycle is expected in next year. So this year, SK Hynix, I think they already guided some increase in the CapEx plan for this year. The majority of the upside is coming from the HBM and the mostly AI, focused product.
Well, just in terms of this result, I mean, obviously, everybody got it wrong. I'd say none of what we've just seen has been priced in to the market. What sort of response do you think we're going to see for SK Hynix shares at the open? And they gained 60% last year. What's 2024 got in store?
Yeah, I think, we can say some the memory cycle, upturn cycle, and the AI, the momentum is priced in. Largely, but we still see some, the robust demand from such AI GPU. So I think that at least, as I mentioned, and also memory cycle is just a rebound, and maybe the price will remain, uptrend until first half this year. So such a strong price momentum, memory price momentum, and also such a continued demand for AI, I think that will support the share price. So moreover, now the earnings is turn around. That is quite impressive in my view.
All right, SK Kim, ex-executive director and analyst at Daiwa Securities. And, of course, we'll see trading of Hynix just in about 25 minutes' time. Certainly a stock to be tracking very closely. But another share price that we're looking at in after hours here is Boeing, because that company is down more than 3% in late trade. That's after the FAA halted expansion of Boeing's 737 MAX planes, including its MAX 9 series. Over 170 of those jets have been grounded in the US. So let's get more now with our transport reporter, Danny Lee. I'm interested just how much this caught you by surprise, if at all, given where we're at in the investigations into what went wrong in that Alaska Air incident as well.
This is really ultimately an escalating response by the US Federal Aviation Administration as it continues its investigation into the blowout of the Alaska Airlines door, which has had ripple effects across the scrutiny of Boeing, its production line, its manufacturing quality, its suppliers. I think what's the key thing here is that the FAA have decided it will not allow any expansion of its production line. And what's key here is that Boeing, its critical 737 MAX cash cow plane, ultimately, it was producing 38 planes a month, and it was going to add a fourth production line in Seattle, which means it could go up to 50 planes a month. And you think about the millions, the billions of dollars it would ultimately generate once this comes to fruition over the next couple of years. At the moment, this is a no from the FAA, and they've been very, very clear here. And they've made some strong words that this will not be business as usual for Boeing, ultimately. And so, as you can see, after hours, the impact is pretty strong.
Danny, the Boeing CEO has been summoned to Capitol Hill for a please explain moment. But more broadly, has something been happening at Boeing over the past few years? Is there a change to culture or production that's behind this string of mishaps?
Well, the FAA has been scrutinising Boeing for the last couple of years already. They've been having greater oversight over its production. And so now what we have seen in this latest fiasco is a firmer response. But when we heard on Capitol Hill earlier today in the US, Boeing saying that they are going to be as transparent as they can be. They are being as transparent to lawmakers who are clearly getting a lot more concerned about what is going on. But then the lawmakers are also then saying we fully trust basically what Boeing is telling us. They're being honest and open in their dealings. So clearly you've got a divide here that whilst there is real heat on Boeing in one sector from the customers of the airlines and the regulators, there is clearly a field in Washington of trying to also support one of its biggest exporters.
All right, Asia Transport reporter Danny Lee there. Let's take a look at how we're tracking on markets at the moment. Here in Australia, we're now better by about a third of 1%. We've got Nikkei futures looking a little bit softer ahead of the open. Of course, it's been a very good couple of months, though, for the Nikkei. We've got S&P E-minis now trading as well, just very, very modestly in positive territory as well. You can see there after hours, IBM shares performing pretty well. We've got Tesla shares a bit lower, down 5.2% after hours. They were off about 6%. The earnings call has now finished for Tesla. All right, still to come, we've got our exclusive interview with the Thai Deputy Minister of Finance, where he discusses the country's central bank policy and how it's weighing down the economy. This is Bloomberg. Thailand's Deputy Finance Minister is amplifying rate cut calls as borrowing costs hover at a 10-year high. Junlapan Amon told us exclusively that high interest rates are holding back the economic recovery.
The problem with Thailand right now is that the economy growth of GDP is not where it should be.
The current central bank policy rate is at 2.5%. Does the government think the economic conditions are in place for 2.5% to be lowered? Does that look too high given the reality on the ground?
The current interest rate is quite concerning to the government. It is too high considering the spending power that the Thai citizen, Thai people has at the moment. It's difficult for the people of Thailand to live with this number, 2.5% interest rate.
The digital handouts, the timing on when that becomes public or when it takes effect?
Well,
yes, give us an update on when you think that might happen.
The initial planning was in May, but that we announced that it has to be postponed.
Is it definitely going to pass, though?
It is in place. The proposed project should be still on within this year.
Within this year, okay.
Yes.
This rift that's going on between the government and the Bank of Thailand, what's going on?
The thing is that the government and the Bank of Thailand is structured in Thailand maybe differently from some countries.
Okay.
Because the Bank of Thailand has to be independent from the government, from anyone, has to be fully independent. The Bank of Thailand mentioned about some issue, for example, the digital wallet project, that they are concerning the successful of the project, the source of fund, which we listen. We listen to that, but we also concerned that right now the bank is a bit too distant from the people. After we announced the digital wallet project, there are so many polls in the country. Lastly, there's a poll from one of the top commentators in Thailand. He asked if people think that the injection of money, the problem about the situation of the economy is real in Thailand. 93% said right now the economy is in bad shape.
Okay.
So the government think and believe that it is imperative that we need to inject money into the system so that people can have better living, have better life.
The targets on tourism, that's a very big part. What happens when tourism plays a very big part on whether you achieve your growth target? 8 million is the target, I believe, for mainland Chinese tourists into Thailand this year, 8 million tourists.
Well, the goal for this year, number of tourists coming into Thailand is 30 million people. Chinese people accounted for 20%.
Okay.
We believe that we can reach that number. After we announced the free visa policy last year, right?
Yeah.
Beginning of this year, the number of tourism from Chinese has doubled already. So we believe that we can reach that number, even though it's 8 million, not too difficult.
That was Thailand's Deputy Finance Minister speaking exclusively with Bloomberg Markets co-anchor David Inglis. Coming up, the criminal hacking gang Lockbit says it was behind the ransomware attack on stock lending platform Equilend. We'll have more details next. This is Bloomberg. The criminal hacking gang Lockbit is claiming it was behind a ransomware attack that caused a Wall Street stock lending platform to crash. Bloomberg's Sue Keenan joins us. And Sue, this is really just the latest in what's been a series of hacks to rock the financial industry.
Yeah, and they picked a very big target in this latest attack. Equilend, which was formed by a group of big banks and broker lenders, including Goldman and JP Morgan Chase, back in 2001, is a key player in what's called the stock lending market through its NGT platform. Now, stats show it processes more than 2.4 trillion in transactions on a monthly basis. So a cyber attack that causes some of its operations to crash or shut down is a very big deal. Lockbit, a notorious criminal hacking gang, has now claimed responsibility in what is now its latest in a series of high-profile attacks. Bloomberg is reporting that the spokesperson for the group said they will try to negotiate with the company for a payment in exchange for unlocking the affected systems. Equilend is in an interesting position at the moment. As mentioned, it's owned by a number of financial firms, but it also just announced plans to sell a majority stake to a New York-based private equity firm, and now a lot of its operations are technically out of its control. Equilend has said it is working with professional advisors and cybersecurity firms to restore everything to normal, but it has advised clients this could take at least a few days.
And so, of course, back in November, a US unit of China's ICBC was attacked in a similar manner. What have we learned since then?
Yeah, at the time it disrupted the Treasury market trading here in the U.S. What we've learned is this criminal hacking gang is prolific. They are organized, and they've been highly successful in taking big financial and other firms offline. You're looking at the headquarters of CIBC, and disrupting their businesses and demanding money in return for restoring things to normal. Now, in November, the New York arm of the ICBC was cut off from the U.S. Treasury Department. Lockbit claimed responsibility for that. Since 2020, Lockbit has carried out more than 1,700 hacks and extorted $91 million from its victims. That's according to the U.S. Cybersecurity and Infrastructure Security Agency. In January, it hit a major software trading firm. In November, in addition to ICBC, it hit the Chicago Trading Company and Alphadyne Asset Management. Now, Lockbit's attacks can be highly disruptive because the group breaks into computers and encrypts data on them so that the companies that are in control of these systems really can't operate them. The gang then demands payment in exchange for a key that can be used to unlock the infected machines. Equilend's spokesperson did not immediately respond to the request for specifics on how they were hacked, but many in the industry will be watching closely to see how this gets resolved.
All right, Bloomberg's Sue Keenan there. The Dutch chip equipment maker ASML says it's seeing positive signs in sales growth after orders more than tripled last quarter. CEO Peter Vennick told us more about the outlook for China as Washington pushes for export bans to hobble Beijing's tech ambitions.
90% of our business in China has to do with mature technology. And that's the technology that we need for all the major transitions. You know, if you think about energy transition, the electrical vehicle transition, digitization, rollout of the smart grid, life sciences, it's all mature technology. That's where the masses are. Yeah.
So what is your message to those in Washington, lawmakers in The Hague even, who are pushing to expand those restrictions beyond the most cutting-edge lithography machines, to expand those restrictions on the sale of lithography to China?
Well, you know, I have full respect for national security concerns. That's not the point. But I think we need to take into consideration that this chip industry has created an almost seamless ecosystem across the globe that has given us massive advantages in terms of innovation and cost reduction. So that from an economic point of view, we need to make sure that that economic system that we have created, which has given us so much benefit, that we keep that intact. It's not about national security. It's about making sure that innovation can keep going.
You're stepping down in April. Does your successor at least have to war game the possibility, the scenario where ASML has to operate in a global market ex-China?
Well, you know, I don't know whether he's wargaming. I don't think he's a gamer, to be very honest. You know, we'll just have to deal with the reality. But I also, you know, I'm an optimist that worries a lot, and I do believe that we have created, macroeconomic systems that are so dependent on each other that I think that is a scenario you can always put into a game, but I don't think that's a very realistic one.
You do not have generative AI without ASML. It's as simple as that. Without your extreme ultraviolet lithography machines, how much demand are your clients saying they are seeing for chip making equipment to generate those kind of AI chips?
Well, let me first of all say that I think the full extent of what AI could bring is not totally clear because it's all about the applications. Yeah? And that still needs to develop. But one thing is absolutely sure. It's going to need massive amounts of compute power and storage, data storage. So I think without ASML, without our technology, that's not going to happen. So it's very clear that it's going to be a big driver going forward for our business and the business of our customers.
That was the ASML CEO, Peter Vennick, speaking to Bloomberg's Tom McKenzie. And sticking with the chip space because we've got trade in Korea and Japan opening shortly, but SK Hynix and its peers could be getting a boost. We've got the Korean memory chip maker. We had its earnings out later and a surprise operating profit. We know, of course, analysts had been expecting a loss, so really one to be tracking. Tesla supplies are also going to be a focus for us because we saw the EV maker posting fourth quarter earnings that missed Wall Street estimates. So Tesla is now forecasting a slower pace of growth this year and also as well working on the launch of its next generation vehicles. So there's some of the major suppliers into Tesla you can see there. Meanwhile, IBM suppliers and peers also to note because we had a positive outlook for revenue and cash flow from the company. And you can see that stock there continuing to track up nearly 8% in after hours. But coming up in the next hour, we'll have BlackRock Investment Institute telling us why they're neutral on China. Plus, we discuss the latest data from the region with Natixis. This is Bloomberg.